What if I told you that thousands of real estate investors lose great investment opportunities, not because the property is a bad investment, but because they don't fully understand how investment financing works? Many people believe they need perfect tax returns, perfect income, and perfect credit to qualify. The truth is, that's simply not always the case. Today, I'm going to explain how successful investors think about financing, what lenders are really looking for, and why choosing the right financing strategy can be just as important as choosing the right overall property. Hi, I'm Tanner Goktepe with the Mortgage Sky Hill team, NMLS number 2171656, and let's get started. You probably heard the saying before, cash is king, and there's definitely some truth to that. Cash can make your offer stronger, help you negotiate better, and often allows for a faster closing. But here's what many experienced investors don't understand. Just because you have the cash doesn't always mean you should use all of it. And you may be asking yourself why? Because cash sitting inside one property can't help you buy the next one. Strategic financing allows many investors to preserve their capital for renovations, unexpected expenses, or future investment opportunities. The objective isn't simply buying one property. The objective is building long term wealth. This is where many investors become frustrated. Maybe you're self employed, and maybe your CPA has done an excellent job minimizing your taxable income. Maybe your W 2 income doesn't tell the full story, or maybe you're paid on a 1099 basis. Many investors assume that means they can't qualify, but that's not necessarily the case. While traditional financing often focuses heavily on personal income, documentation, there are some investment loan programs that evaluate a transaction differently. Depending on the loan program, the property's income may play much a larger role in the approval process than many people realize. That's why it's so important not to assume you don't qualify before exploring your many different options. One financing option you may hear about is called a DSCR loan, which stands for debt service coverage ratio. It sounds technical, but the concept is actually very simple. Instead of asking only how much income does the borrower report, the lender may also evaluate, can this investment property generate enough income to support its mortgage payment? That's one of the reasons DSCR financing has become so popular among real estate investors. Every lender has its own guidelines, but understanding how these programs work can open doors that many investors didn't realize even existed. Now let's talk about credit. Your credit score absolutely plays an important role in the process. Generally speaking, once you're in approximately the 640 and above range, many more financing options begin to open. A stronger credit profile can often lead to more choices, better pricing, and more favorable loan terms. But remember, your credit score is only one part of the overall picture. It isn't the only factor lenders consider. Another key piece of the puzzle is your down payment. For many investment property finance programs, having approximately 25% to 30% down can significantly strengthen your financing options. It shows financial commitment, reduces risk to the lender, and often provides access to a wider range of loan programs. Here's something many people don't realize. Lenders don't usually make decisions based on one number. They evaluate the overall strength of the transaction. That includes your credit profile, the property's cash flow, your down payment, and your available reserves, and also the property itself, and the loan program that best fits your investment strategy. Every investor's situation is different. That's why financing shouldn't be treated like a one size fits all solution. One of the biggest mistakes that I see is someone speaks with one lender, that lender says nope, and they immediately assume every lender will say no as well. That simply isn't how this industry works. Every lender has different underwriting guidelines, different loan products, different risk tolerances, different investor programs. Sometimes the difference between a declined loan and an approved loan isn't the borrower, it's the lender. That's why choosing the right lender can be just as important as choosing the right investment property. My role isn't simply helping someone complete a loan application. My responsibility is understanding your investment goals, evaluating your financial options, and matching your scenario with the lender that fits your situation the best. Because we work with multiple lending sources, we can explore different solutions rather than trying to force every single person we talk to into the same financing box. Every investor has a different story and every property is different. Your financing strategy should reflect that. If you're thinking about purchasing an investment property, don't assume you don't qualify based on one conversation or one opinion presented. Take the time to explore your options. The right financing strategy can make a meaningful difference in your investment journey. If you found this video helpful, I'd appreciate it if you would like this video, subscribe to the channel, and share it with another investor who could benefit from this information. And if you have questions about your specific situation, I'd be more than happy to have a conversation and help you understand what financing options may be available to you. I'm Tanner Goktepe. My phone number is 813-568-2291. My email is T and my last name, so Goktepe at pmfmortgage.com. And our website is www.mortgageskyhill.com. I'll have all of our information pinned below in the description, and I hope that you have a great day. Thanks again for watching, and take care.